Hello, this is Doug Gerlach, Editor-in-Chief of the SmallCap Informer stock newsletter. Welcome to our 2023 subscribers webinar, where we're going to take a look at the year that's just passed and the year to come. We'll introduce our top stocks for 2023 shortlist for your education, and we'll also be available to take questions. So I'm glad that you could join us for this presentation. It will be recorded and available on the SmallCap Informer website for subscribers in the subscriber area. So if you want to review it at any point, please feel free to do so after the presentation. There is a handout of the slides for our presentation today, and you can find that in the Handouts tab, and you will also find the questions box there, and that's where you can enter questions as they may arise during the presentation, or if you have any questions about the newsletter and our methodology, the selections that we have, please feel free. This is your opportunity during this webinar to ask those questions, and we will do our best to address them. In the back office today is Russell Malley and Sean Pulrang from our staff, so they may be able to answer questions that you type in as well. I'll be monitoring those as we go, and I'll do my best to address them during the presentation. We'll take a couple of breaks to look at the questions. So let's take a look first at small cap and the entire performance of the stock market in 2022. A difficult year for many investors. Here is the entire year in the three market segments that I like to focus on. The green is the S&P Small Cap 600 Index. The blue is the S&P 500 Index, and the red is the EFA Index. That's the Europe, Australasia, Far East Index that represents large cap stocks in developed countries outside the United States. So that's a great way to look at the international stock market performance. And you can see they were pretty tied together for most of the year. As you look at the peaks and valleys, all three of these segments were tracking each other pretty carefully throughout the entire year. I will point out that small caps ended the year slightly higher than large caps, and but the international stocks came out on top, and that's a rarity over the last decade. The large cap international segment has trailed domestic stocks during most periods, most annual periods, to be sure. We will also make a couple of other observations from this graph. You will see that after the first half of the year, when the market started to make some mini recoveries, the small company stocks were out of the gate first, reached higher peaks, and then as the market retrenched, they came back down, met up with the large cap index, and then repeated that a couple of times in the last half of the year. I take that as conviction of the market. The market wants to go higher. Stocks want to be breaking out. And small company stocks, as they do, lead the way out of bear markets into recovery. So there's signs that the market is ready to be done with this particular bear market phase and on to bigger and better things as we go. I think there's plenty of evidence. We'll talk about economic indicators and an outlook for the market for 2023, but I think there's plenty of evidence and conviction for a positive 2023, and I will back that up with some with my feelings and investigation on that particular topic, because if you're paying attention to a lot of the media, there's a lot of fear mongering going on. There's a lot of negative attention being brought to the market. There's a lot of fear being instilled into investors' minds, and I think a lot of that is unwarranted. If you look at the long-term trend here, again, those three market segments going back to 2002, and this is why you're here today. The small company stocks tend to outperform over the long term, especially large caps, international stocks, and we will continue to bet on that in the long term, even though in interim periods that may not always be the case. In the long term, those smaller company stocks will tend to outperform large caps. Let's talk about our performance for 2022 for the Small Cap Informer newsletter. Reminder, our selected index is the S&P Small Cap 600, which represents high quality small company stocks and is a better representation of small company stocks than the Russell 2000. The Russell 2000 includes a number of companies that are much larger and market cap well outside our size range, and is not selected. The companies are not selected because of any fundamentals to be in the Russell 2000 index. It's purely a matter of their size. So I like comparing results to the Small Cap 600 index, which is comparable to the S&P 500 in that the companies that are selected have particular characteristics that match better with our approach to the market. We do acknowledge that we're not always going to exceed the overall market, but our belief is that if you are investing for the long term in a well-diversified portfolio, you should have a healthy chunk of small as well as large companies, and over time that portfolio construction will lead to an optimal risk-reward characteristics where the smaller companies perhaps are more volatile, but provide more of total return, and the large company stocks provide stability and a little less capital appreciation, but perhaps made up with a little bit of total income and current yield. And so put it all together into one big pot, and then you will be best poised for long-term success. Here is our performance for the 12 months ending January 9th. Our Small Cap Informer selections were underperformed the S&P Small Cap 600, and that's the first time in an annual period that's happened in many, many years. But our 3-year, 5-year records still, we are besting the Small Cap 600 index, and our lifetime returns are also outperforming the small company index. We're of course a little disappointed but in the 1-year results, but we don't put too much stock in short-term returns. We'd much rather be focusing on the lifetime, the 3-year, the 5-year, and 10-year returns of the newsletter selections. But that's the way it fell out for the year. We're optimistic about 2023. We've set some internal objectives that I thought I would share with you now. Our coverage list has always been around 50 companies. We find that over 50 companies is just too unwieldy to manage, and it provides too many companies for subscribers to select from. We're currently around 47. Ideally, I would like to be even fewer companies than that to focus on it. The problem with focusing on a smaller list of covered companies is that we end up repeating recommendations on a more frequent basis, and so we end up with companies that we recommended 3-4 times over the course of perhaps 10 years, 8 years in some cases, which I think is fine and reflects the way that many individual investors should be investing, evaluating the companies that they own and adding to those positions. But it is a balancing act, and we know that subscribers like to see new ideas, so we're trying to balance those two objectives. We would like to continue to evaluate our sell recommendations, especially with respect to timing and criteria and discipline. This year we saw a number of our picks we probably let go too long waiting for recovery, and that's the same thing that happens with individual investors where cognitive biases get in the way. So we've are having discussions and taking a look at how we can improve that. I talked earlier in the year about avoiding company size creep in the portfolio. We had a number of companies that had grown much bigger. I think that was possibly one of the reasons that our performance fell a little short this year, is that we had some companies that were mid-sized companies and even bursting out of that mid-sized, mid-cap range a little bit. So we're trying to refocus on smaller companies and taking a different approach to managing the small companies that perform well and then turn into mid-sized companies. We continue to evaluate the integration of technical indicators, particularly if there could be some ways that we can integrate those to generate some sell prices on the downside. Some low prices that would reflect when the market sentiment is turning against a company. Instead of riding it down on the conviction of fundamentals, maybe we should be exiting those companies. And so we're continuing to take a look at that. We already do provide on the website, updated each night, a series of technical indicators for all covered companies. We're looking to expand that and make those more readily available and integrated in other portions of the website. And as always, we'll want to continue to identify the best candidates from the entire universe of well-managed smaller companies that are selling at reasonable prices. That's been the case since day one, and we don't expect that to change. We will continue to work on the premises of identifying quality companies that have a track record of growth, have strength relative to their profitability compared to peers and industry averages, and that also are selling at reasonable prices. We still don't like to overpay and are eschewing high PE stocks as much as possible, but we continue to, again, review those criteria and make sure that they're working to their best benefit for the newsletter picks. So let's turn to the current economy. We're going to take a look at the big picture of the economy, which of course trickles down to small companies and affects them just as it affects large and mid-sized companies. As we head into 2023, much of what I had predicted earlier in 2022, especially in the mid-year and into the fall in various presentations, are really playing out. I'm very comfortable with where we are now in the economic cycle, and my conviction about the state and health of the U.S. economy still remains. I had suggested that the economy wouldn't be deteriorating any significantly worse than it had by the middle of 2022, allowing for perhaps things to get worse before they get better. And that's indeed been the case. We have not entered into, I don't believe, a full-blown recession. And I continue to believe that gradual economic recovery is more likely than a continued drop-off in economic indicators. And so definitely been seeing those positive upticks on many of the economic indicators that economists and market watchers like to pay attention to. Throughout the entire year, and this has been the case for the last decade, we've had a series of mixed economic signals, which means that at any point in time, you can point to some aspect of the economy that's not fully engaged or is experiencing some slippage. But on the other hand, you would have pockets of the economy that were performing quite well. And those mixed signals are terrific fodder for the media because they can pick and choose and cherry pick the ones that support their story. But all in all, put them all together, it is not creating a case that there's a disaster in the making, and that continues to be the case today. We'll take a look at some of those selected indicators in just a couple of minutes. And so where we stand now at the beginning of the year, we've still got Americans who are not experienced with inflation. Many people have never experienced significant inflation in their lifetime. If you're in your 50s or 60s or older, you can remember periods of high inflation and high interest rates and high mortgage rates, but today that is not the case. Today, Americans' only experience with bare product shelves has been during the pandemic. But again, if you're older, you can remember times when we've had shortages, when grocery stores did not always have 40 different varieties of salad dressing. Those are all a matter of perception, I think. And those experiences that Americans are seeing right now, that they're going through with respect to the economy, is causing them to describe themselves as having low confidence in the economy, but they're not behaving in any way that you would if you were truly not very confident. So they're not shifting their behavior. If you were nervous about the economy, you wouldn't be buying cars, for instance, but consumers are. You wouldn't be traveling, but consumers are. So we're in this position where if you ask people, they say, yep, I'm nervous about the economy, but on the other hand, they're spending their savings. They're behaving in ways that belie that stated belief. And so again, I think that has a lot to do with where we stand in the economy and what our takeaway is. So the recession risk in 2023, I believe it's possible. If it does happen, it would likely be short in duration, and there's a slight chance from here that the economy could worsen, but I think it's likely we've seen the worst, and I don't think it's wise to in any way to bet on further widespread economic deterioration from here. I think that would be not a very savvy move to make. Yes, there's one thing to be a little bit defensive, but to go all out defensive, to move to cash, for instance, or to adjust your portfolio of stocks to eliminate any companies that would be adversely affected by the economy, those would be foolish moves that I would not recommend. Goldman Sachs, Morgan Stanley, economists are in this same ballpark. Not having any sort of conviction that 2023 is going to be a terrible year. Again, we're always prepared for the worst, but we're not betting on it by any stretch of the imagination. So I think we can pretty much start moving that recession talk off the table. Inflation, with respect to prices, they are high, but inflation is definitely easing. Consumer prices were up 8.2% year over year in the third quarter of 2022, but Goldman Sachs is expecting that inflation rate to drop to as low as 2.4% by the end of the year. So they're really seeing the pieces coming into play to ease that inflationary aspect of the economy. Certainly, if we look at core inflation, and I'll show you a graph in just a minute, it's been going down in each of the three reported months following August 2022 when it peaked, and that's expected to be negative by 2023. That core inflation rate is something that I like to consider in lieu of the broader measures of inflation. And when you track it over time, again, you see some different trends. The supply chain that we've been worried about over the last couple of years, the last 2 years since the pandemic began, the drivers of the disruption were already in place, and the pandemic really exacerbated them. And I think I was expecting that recovery to come a little bit sooner. We're still waiting to see. We've got companies like Skyworks and Universal Display that are still getting hammered by issues with the supply chain that's just slowing manufacturing down, creating maintaining shortages of chips in many cases in the semiconductor industry. But there is definite improvement there that we can point to. And as I mentioned, there's high prices and low confidence, and consumers are spending. And I think that this balance of pessimism and spending is good for the economy. If people are a little bit pessimistic, they're not going to be so surprised when something bad happens, when the economy does suddenly tick over, when there are some significant changes, if that were to be the case. And again, I'm not betting on that at all. When we look at core inflation, as I mentioned, this is a graph that we looked at in our last subscriber session in the middle of the year, you can see the last time core inflation exceeded 3% on any sort of regular basis was in the 1980s. So if you don't remember what a record player was, or a typewriter, or a landline phone, you don't remember when inflation exceeded 3% as it did in 2022. And again, points to my belief that consumers have no experience with rising costs. And so if you have no experience with something, you find it fearful, you tend to behave in irrational moves, in irrational ways. As you look over on the far right side of this graph, though, you can see that little downtick. That's 3 consecutive months where the core inflation rate has fallen off from the peak that it reached in August of 2022. Yes, those are small moves, but I think that is the start of a leveling off of that high period of higher than normal inflation. Where it ends up, again, if you're looking at the Goldman Sachs prediction, about 2.5%, that would still be much higher than most of the 2010s, but that would still be what would be considered a very reasonable rate of annual inflation. But when we talk about inflation, I keep coming back to the point that inflation may not be what you're hearing the causes of inflation to be. Robert Reich, who's former Secretary of Labor, wrote at the end of the year, memo to the Fed, your rate hikes aren't slowing inflation because inflation is coming from big corporations using the cover of inflation to increase their prices more than their costs. Simply put, Reich says that big companies are complaining about rising costs and wage inflation, costs of labor, costs of energy, and they're pushing through price increases that improve their margins, but the real cause is not any substantial increases in their own raw materials and their own services and products that they use to make or deliver what their company provides. And when you look at 2021, it was the most profitable year for American corporations since 1950. And so by another measure, over half of the increased prices that consumers are paying in non-financial sectors are coming from increased corporate profits. So the story that increased costs are causing prices to go up is not nearly the entire case. If you look at this graph of corporate profit margins, in 2021, they were the highest since 1950. So profit margins increased significantly during the pandemic. Yes, prices have gone up, but it's not necessarily because of inflation of raw goods and materials, but more case of companies taking advantage of the cover story to increase their profitability. Certainly as 2022 comes to an end and we start looking at profit margins for the year in our tools, we will be able to identify that. We've already seen that in many cases, companies seeing increased profitability in 2021. But again, it was easy to say, oh, they're coming off the pandemic, they're normalizing their situation. But as we get into 2022, it could be a different story. Here's a struggling energy company, ExxonMobil. Look at their profit margins as of the third quarter of 2022, the highest level since 2016, the data that I have on this particular graph. Yes, margins fell in fourth quarter of 2020, but they came back and they have been higher than ever. So yes, fuel costs are going up. How much of that is because of the underlying price of oil, and how much of it is because of the profits that are being delivered back to ExxonMobil shareholders is something to consider. In terms of interest rates, there are all sorts of predictions. I expect the Fed to continue raising for another few rounds based on Jerome Powell's comments even this week that they're committed to fighting inflation no matter what it takes. So to me, that's signaling they're not done raising rates. Expectations are for some more rates reaching perhaps for 0.75 to 5.25%, and then probably holding off for most of 2023 before starting to reduce rates. Again, I think this will deliver a soft landing if it all works out as the Fed anticipates. There's plenty of uncertainty here, but again, if rates top out at that 5% range area, I think that's probably a good for the economy and something that certainly the economy can absorb. Rising rates are certainly pressuring stocks a little bit since TIA. You may remember TINA, there is no alternative, which was holding up stocks for much of the low interest rate periods of the 2010s. But now we're heading into, there is an alternative. 4%, 5% could be drawing some people out of the stock market. It's a low interest rate of return, but it's a risk-free rate of return. And so that could be part of the whole recipe for the case that stocks might not kind of rebound as much as we want until interest rates come back down a little bit. So something to keep in mind there. And there's no winners or losers in the interest rate predictors game. It is what it is, and plenty of people are watching the Fed like hawks to see if they're going to behave like hawks or doves, and there's no predicting it. I think in our approach to selecting stocks, we like it when companies can take advantage of lower interest rates to improve their balance sheet, but we also like it when companies are able to utilize their cash and don't have to resort to borrowing. So well-managed companies are going to function well no matter what happens with interest rates. Talked about consumer confidence. Consumers are saying they're worried about the economy, but in August of 2022, spending rose faster than inflation. In September, retail sales went up as much as inflation. So rising prices didn't cause people to say, oh, things are getting expensive. No, consumers were spending. In October, retail sales were stronger than they would be in the next month, November. That was as consumers made an early start on their Christmas shopping in November, probably getting out of the gates a little early, but pushing those sales back into October. Made for a softer November, but retail sales were still up 6.5% over November 2021. And then from November 1st through the Christmas Eve, retail sales are looking to be up about 7.6%, according to MasterCard. Online sales hit a new record. They were up about 3.5% in the holiday spending period. This is not the behavior of a consumer citizenship that is worried about the economy. Spending was strong. We'll see how the retail stocks turn in their results for the fourth quarter. But so far, things are looking very positive for the end of the year. Start this slide. History may well cite the pandemic years as a breakpoint in all sorts of labor and workforce trends, ranging from working at home to distributed workforce, worker satisfaction, worker wages. There have been a lot of trends that were in place, such as raising minimum wage, that I think the pandemic probably helped to accelerate. Again, I haven't seen evidence of any worker shortages. What I'm seeing is a wage problem, because you can always get people to do a job, find workers if you're willing to pay them a wage that's acceptable. And so if you can't find workers, you need to adjust your whole business model in order to account for it. Unemployment has been remains low. It's been a healthy 3.5% right now, which is a good level. Many companies, because of the pandemic, because of changes in their workforce, are running lean payrolls, and which means wouldn't really expect any further widespread layoffs in 2023. Companies are having trouble filling the most skilled positions. Again, that argues against massive layoffs. I know we've seen headlines last week about Amazon laying off 18,000 workers. And that is seen as this major catastrophe. Amazon has more than 1.5 million employees around the globe, so this is well less than a 1% reduction in their entire workforce. I think that there's just about any business that could absorb a 1% reduction if they needed to. It's a healthy way of refocusing your business and improving worker productivity on average across your remaining workforce. Your typical Walmart store has, I think, between 350 and 400 workers. So if they needed to lay off 3 or 4 full-time positions, it would not cause any widespread or severe problems. Yes, maybe the checkout lanes would be a little longer. Maybe the store shelves would be stocked a little more slowly for a time, but it would certainly not cause a big dent in the operations of that business. So, so I think that, again, the headlines tell a story, but on reflection, it's maybe not the big headline. Automation was making gains prior to the pandemic, and we'd expect that to continue, but we're not going to see huge traction. It takes time to shift over systems and to shift over consumer behavior. Certainly, you may be among that class of people who will never use a self-checkout line at the grocery store. Again, that's fine. The grocery stores were not putting in this technology for self-checkout lanes because they didn't like hiring high school students to work the checkout lanes, but because they couldn't find the students to work the checkout lanes. So it's a response. Same thing with fast food restaurants and kiosks, mobile orders. That's all going to continue. We've seeing reports of restaurants that are fully automated, so a completely roboticized restaurant making food. And again, if it works, it works, and there will be debating opinions upon it. We're not going to see anything major happening this year, but I think the trend is in place. Workforce participation will probably edge up in the year. We've had a lot of people pulling themselves out of the workforce, but as the savings rate has been dwindling down and people have been spending out that savings, they're going to need to go back to work. So that will help ease some of the worker demands, the labor demands of many companies. The business owners, when you survey them, they, again, say they're feeling pessimistic, but they're investing in their businesses, they're making capital purchases, they're hiring, they're raising wages. The Conference Board's survey of CEO confidence said that 44% of CEOs expect to expand their workforce in the next 12 months. 85% expect to increase wages by 3% or more. 86% expect their capital budgets to increase or at least remain the same over next year. 48% of middle market executives, so mid-sized businesses, reported their revenues increased in the third quarter, but 60% believe the next 6 months will get even better. So again, these are business owners who have they don't need to worry about making positive statements to the press. They're just talking about their own businesses, and I think that's a good measure of the economy and the economic health of business in the country. In terms of housing sales, again, if you look at the far right of this graph, you can see that things have definitely bottomed out and have been ticking up since last July. We've had that decline, and then things since July have been bouncing back up in November. Those one-family houses that were sold ticked back up again. I like to look at this graph going back to the 1960s because it shows the supply as it peaked in 2007, 2008, as it declined during the housing crisis and was ticking back up. But we're still nowhere near at this point the peaks that we've seen in most of the decades since the 70s, and certainly not in the 2000s. So again, we're not seeing big disasters in the making in the housing market, and there still is demand for housing in the country. If you look at the rental housing market, this is the renter occupied housing units available in the United States. And again, there's a drop off during the pandemic, but quick recovery and those levels in the last few months have been commensurate with the levels going back to 2016. Yep, there's a little bit of variability, but we're at that level. That's a good sign. There's need for housing. The market recognized it, builders recognized it. They started building rental apartments, and that supply is coming on board and is fulfilling a need there. Again, developers wouldn't be building rental housing if they didn't think they could fill it. So those are pretty positive moves for the general economy. And then finally, mortgages. People complain that mortgage rates are too high. Again, if you look on the far right, they've been dropping off ever so slightly since reaching a peak in October. But the key takeaway is how the current levels, even though they're elevated compared to where mortgage rates have been in the 2010s, go back to as recent ago as 2000, and mortgage rates were much higher. And going back from 2000 into the 90s and 80s and 70s, mortgage rates were much, much higher. So there are plenty of homeowners who bought their houses in the 70s or 80s at those fixed rate mortgages that might have been 15, 17%, who are laughing at first time home buyers who are complaining about having to pay 6% for their mortgage. So over time, it's a matter of perception. It's a matter of just understanding interest rates. First-time home buyers need to be saving money instead of relying on programs to make those purchases. But if you really want to buy a house, there are mortgages available that are affordable on a historical level. All right. Yep, taking a look at the questions. Yes, as I mentioned, we will be recording this webinar. We are recording this webinar, so it will be available in the SmallCap Informer website in the subscriber area after the presentation here. So we've talked about the economy. Let's turn now to the markets. We look at the S&P 500 PE ratio over time. That level of where we are right now at 20.39. That's high relative to recent history or to long-term history, but low relative to much of the last 20 years. So PEs still remain a little elevated on a trailing basis. On a projected basis, they're a little cheaper based on pretty optimistic estimates for 2023. But yeah, those markets, PEs have come down. We haven't really seen PEs of 20 or below since 2013, 2014. So it's been a nice long time since PEs of the S&P 500 were as cheap as they are now. Historical earnings, however, continue to climb. Fundamentals are strong. You can see the graph here that companies, the large caps, are continuing to make money, and they're continuing to sell products. Here's the historical sales per share. And you can also see, as you notice here in 21 and 22, the sales took a big uptick over, faster than the long-term trend, to be sure. Part of that was recovery from 2020, but a large part of it is more than just recovery. The 10-year Treasury rate, again, edging up 3.61% currently. Maybe that will tempt some people away from the stock market, but and again, it's still it's much higher than it was. But again, Treasury rates have been much higher in much of the historical past. We're at a level that goes back to the 40s, 50s, 30s, that level. But we've seen that gradual decline over the last few decades. Dividends remain not much of a story for large caps in general. I like to point this graph out to investors who are interested in looking for current income through stocks. The average yield of companies has changed significantly since the 1950s and before, and that 1.71% yield of the S&P 500 currently is pretty meager. Companies today are not paying dividends if they could buy back shares or instead, and so that will continue to be the case. I wouldn't expect companies to jump onto the dividend bandwagon in any big way in the current year. The economy and the stock market are tied together, but they don't always perform in the same way. We don't have a recession just because we have a bear market and vice versa. So even though we're in a bear market for stocks, the economy could be chugging along sideways, slightly increasing. But more importantly, it's key to understand how economic slowdowns impact the companies in which you're investing. So know how the economy and how a recession would impact any stock in your portfolio or that you're considering purchasing. We cover a number of home building, construction, RV companies. These are highly susceptible to the economy in typical history. They are abnormally cheap right now, but they may require significant amounts of patience before the market and the economy delivers enough gains that investors gain confidence in those companies once again. So even though these are the companies that are at the top of our total return sort, I think it's good to have one of them, maybe two of them in your portfolio, that you're going to be patient. You're going to wait for the market to turn around and acknowledge that those companies are still delivering good fundamental strength. But I wouldn't overload just yet on those types of companies. That's not, I'm not disagreeing or contradicting anything that I've said earlier. It's just a matter that the market doesn't always recognize what sensible, rational people do. And so you've got to be patient when you're buying those types of companies. The other types of businesses that you might watch carefully right now, any sort of makers of non-essential goods and services, luxury goods, new cars, heavy equipment, travel, entertainment. Seen some big fallout this year on the used car dealers. Part of that is the business of used car sales. Part of it may be related to the economy. Part of it is related to supply and demand, but certainly high-priced cars tend to see sales decline when consumers are worried about the economy. And defensive companies are those that offer essential goods and services that they maintain sales and earnings during during recessions and economic pullbacks, discount stores, fast food restaurants, healthcare companies, utility companies, grocery stores, drugstores. They're among the most common of the defensive industry stocks, but those are expensive right now. Just like insurance, the best time to have those stocks in your portfolio is when nobody is concerned about the economy. It's the best time to buy insurance is when your house is in fine shape, not when it's in a storm or on fire. So those types of defensive stocks can be expensive. And one observation to keep in mind when you look at various sectors right now, a lot of technology stocks are inexpensive, while a lot of defensive stocks are expensive. And that's the self-selecting nature of those sectors with an approach that has a strong discipline in valuation. In other words, because we don't want to pay too much for companies, when those companies in particular industry groups or sectors are expensive, we tend to stay away from them, and vice versa. When those companies in those sectors and industries are more attractive, then we would be buying them. So right now, maybe it's a better time to be looking at technology companies, especially the fallen angels among the large caps, as part of your investing approach. When you're looking at healthcare stocks or utility stocks or the consumer defensive stocks, you're just not going to find as many opportunities there. So I think that's just keep that in mind. I like to preach the advantages of building a defensive portfolio when we're in good times, and that's to prepare us for the tumultuous markets and economy that we are experiencing right now. Individual investors are bearish right now. This is the AA sentiment survey, and you can see the results over the last 4 weeks. The 4 reported weeks. The green is the percentage that are bullish, the gray is the percentage that are neutral, the red is the percentage that is bearish. Down at the bottom, the historical averages. On average, investors are bullish. 37.5% of investors are bullish, and right now 20.5% are bullish. So right now, in the last month or so, investors have been overwhelmingly bearish or neutral. And the takeaway from this survey that's borne out since the AAIs have been doing this since the 1970s is that when investors are bearish, that's a bullish indicator. When investors are feeling bullish, that's a bearish indicator. And so right now we're at a very low level of bullish sentiment. We're at a very low level of bullish sentiment, which is bodes well for the bigger market. When investors are at those higher levels of bearishness, that tends to precede a strong market. But of course, we invest in stocks, not the market. Well-managed companies will always grow. Capital appreciation will follow in time. Growth companies will stand out during recessions and bear markets. We look at the fundamentals of so many of the stocks that we follow in the small cap informer. The evidence is there. These are well-managed companies. So the fact that they're selling at such reasonable valuations is a testament to the strength of market sentiment and not to the strength of their own fundamentals. Another advantage of investing in individual stocks, when you pay attention to quality and valuation at the market peak and market bottom, you're able to take advantage of your measurement of valuation and react accordingly. So during bull markets, when things are overheated, you might be able to pare down your overvalued holdings. That in turn, when the market turns around, will reduce the amount that you might be subject to seeing fall out of your portfolio value. During these times of turmoil, history suggests these are the perfect time to be investing in the market. This is the perfect time to be increasing your 401k contribution on a regular basis, to be increasing the amount that you're moving into the market from savings, for instance. And keep in mind that when recovery comes, it will come quickly. Small and mid-sized companies, many of which are offering compelling values right now, are going to be the first out of the gate. So now's the time to be thinking about buying underpriced stocks. If you're a little nervous, you can still dollar cost average or baby step into undervalued companies. There's a value of taking a big position, but there's also a value sometimes in knowing when it's good to break it up and invest instead of investing $100,000 all at once, and investing $30,000 one month, the next month, spread it out over time. That just helps with your own perception of risk and reward, and kind of battle some of the cognitive biases that we're always up against. Right now, there's nothing in my approach or my belief that would shake our belief that bear markets are opportunities, and that when recovery happens, there's not going to be a telegram or a phone message or a text that comes to tell you that it's time to move into the market. The market, as always, tends to concentrate its gains on a few market days, so you want to be in it in order to win it, remain fully invested. Let's go ahead and we'll talk about our 2023 top small cap stock shortlist. These are this year's 6 companies that we've selected. Many of them are recently covered companies. About half of them we've covered in the past more than one time. The other 3 are companies that we've only recommended once, but all 6 of them, I think, offer opportunities. They're spread out into different sectors and industries. You can grab the PDF with a little more description from the handouts tab, or you can get it on the SmallCap Informer website in the subscriber area. The idea here is that, again, we recommend stocks every month, but sometimes we like to focus on stocks that we've covered in the past that provide attractive metrics that suggests that this is a good company to reconsider. If you already own it, consider adding to your position. If you skipped out the first time around, maybe this is your wake-up call to maybe consider adding it to your portfolio again. Couple of the companies, let's see. A couple of the companies are up significantly since we recommended them initially, or most recently, I'll say, and a couple of them are at or down slightly since we recommended them, which puts them even further into the buy zone from our perspective. Anyway, here are the 6 companies. I'll go through them one by one on the next screen, but this chart, which is in the document, includes the current price as of the beginning of the year, the current PE, the projected earnings per share growth rate, projected total return on an annualized basis, the relative value right now. You'll notice they're all below 100%, above 60%. The upside downside ratio, all better than 3 to 1. 2 of the stocks pay yields, so one of them is more appropriate for income people who are looking for a little more on the income side. The buy and sell above prices, buy below and sell below prices as well. Our first stock is Clearfield. We recommended it in the July 2022 issue of the newsletter. This is a communications equipment provider that is active in the fiber optic space. And if you thought everything was going wireless in the communication space, this is a great company that disproves that, because at some point in the chain, those wireless transmitters and receivers need to be connected up to a network, and fiber optics is the way to do it. And we've still got problems. The 5G network that is rolling out is indeed much faster, but it requires more cell towers, more access points, because it's faster, but it doesn't have as much distance to carry the signal, and it also is much worse at transmitting through buildings. So 5G access points have to be built out, and they have to be connected to the network. So Clearfield is making the equipment and supplies that are allowing for those connections, as well as the increasing use of fiber optic connections to internet in homes and businesses. And they've had a terrific run in the last couple of years, and that's looking likely to continue. We recommended them in July and they're up 70% since then. So it's had a phenomenal run, but they're still in the buy zone. The growth is still coming fast and furious, and so we really see them as having a good future in that communications industry. Communications equipment is part of the technology segment, but this is playing on trends in the communications services sector, so it kind of crosses over from that perspective. We're looking at 18% growth on an annualized basis, which I think is a little conservative. You can see my trend line here, my projection line here rather, is a little bit falling short of the analyst estimates for sales growth going forward. So I think there could be some additional upside built into investing in Clearfield. $270 million, so it is a small company, but it's got some good prospects going forward. Oops, sorry. Oops. DLH Holdings is another company that we have covered most recently in November of 2021, and we also covered them in October of 2022. They were the current price is even below both the prices in October of 22 and November of 21. Oh, I had this backwards. So most recently October of 22, and first time we covered them in November of 21. So they're down 12 and 17% since then, but you can see fundamentally they're still continue to be strong. This is a service provider that serves government contracts, primarily with the Department of Defense and Veterans Administration, but also with a number of other government agencies. A small business, $395 million in revenue last year, but they do have a new security authorization that should allow them to compete for more contracts, and they're expanding their business within the government agencies they serve and outside the government as well. And that gives them a good growth trajectory going forward. It's not followed by very many analysts, which is why it doesn't get a lot of attention, but it definitely has what we like to see from companies that we're following in the newsletter. Margins are strong, and outlook is good, and our projections are pretty conservative compared to guidance and analyst estimates for the analysts who do cover this particular company. Innovative Industrial Properties, a little more controversial. This is a real estate investment trust that focuses on medical marijuana cultivation facilities. It's a triple net lease business, which means that they lease out the building and collect rent, and then the tenants are responsible for taxes, for upkeep, for expansion, for operating costs, for rent, etc. And at the end of the lease, Innovative takes back the building, right? So it's a very profitable way. In the cannabis industry, as it is so young, Innovative plays a part in helping to finance those businesses. So they build the building, in essence, working with the cannabis company, and then lease it to those companies. So thereby they earn back their investment plus. So interesting business. Cannabis is here to stay by 2025, all U.S. states are expected to have it authorized for medical use. Those medical use growers are who Innovative supports. 19 states that they have properties in, 111 properties. So it is not a tiny niche business, even though they're very isolated in that particular sector. As soon as we recommended it in July of 2022, one of their customers in California announced that it was entering bankruptcy and restructuring. So there was some question about how that would drag on Innovative's earnings with the loss of that tenant. Now that tenant is they're still negotiating, they're still working their way through bankruptcy. Innovative applied security deposit towards the rent and has been working with the business to come to terms. Again, the business is so niche that you can't just simply turn around and find a new tenant very quickly. Although many states are deploying. I think the state of Connecticut yesterday opened its recreational cannabis facilities, for instance. That's all going to play into Innovative's growth going forward. So lots of regulatory changes ahead, but still plenty of opportunity for Innovative. And the 5.6% current yield gives you some income along the way. And then I think there should be some capital appreciation that driven by fundamental strength. I'm looking for 11% annualized growth, which I think should be pretty easy for the company to achieve. InMode is a company that makes non-invasive technologies for carrying out aesthetic face and body contouring, so plastic surgery, cosmetic procedures, $357 million, so a small business. They actually announced late after the close of the market yesterday, they announced results. They pre-announced their fourth quarter and fiscal year results that were well in excess of their guidance. So the revenues and earnings that they pre-announced were much better than analysts had expected, much better than the company's internal guidance that they gave in their third quarter conference call. And of course, today the stock is down 8% because that's how the market reacts to positive news. The company is primarily their primary market is the United States, although they serve 70 countries, and they've been expanding into women's health practices with so not only plastic surgery, aesthetic physicians who are doing aesthetic, purely aesthetic procedures, but other aspects of health and medical, gynecology, dermatology, endocrinology, ophthalmology, etc. So all sorts of practice areas. What's interesting is as they roll out these platforms, they also service the disposables market, and that's recurring income. And the amount of that recurring income is continuing to increase as they place more and more devices. The bear case for InMode is that during a recession or economic hard times, then customers of healthcare do not purchase non-essential procedures, and so that's the bear case is firmly in that rationale. But I see the long-term prospects for non-invasive procedures to continue to grow. Ask anyone who's had a knee replacement or a hip replacement or internal surgery in the last decade, and chances are it was robotic assisted, it was non-invasive, it was using all kinds of current technology as opposed to breaking out the scalpel and making large incisions. So I think this type of business is got a great growth pathway in the medical devices segment. This stock is up 220% since we started. Oh, I'm sorry, this stock is down 2% since we started covering it in April of 2022, plus a little bit more today. So it is firmly in the buy zone. It's had a great string of quarters since we started covering it earlier in the year, and this fourth quarter looks to be solid as well. So if you're looking for a medical device stock, a healthcare stock at a reasonable price, this could be something to consider. Nova Ltd, Nova Limited, used to be Nova Measuring Equipment, a longtime favorite. We started covering it in June of 2018. It's up 229% since then. We reiterated the recommendation of in June of 2022. It's down 16% since then, but you can see the quarters have been strong in 2022. The expectation is that that's going to continue into next year and beyond. Nova is a metrology business. That's the science of measurement. They make equipment that's used for precise measuring in the production of advanced semiconductor chips. So it's a semiconductor equipment stock. Their customers include, it's like a who's who of the technology industry. Their customers include Amazon, Broadcom, Qualcomm, Apple, NVIDIA, Meta, Samsung, Intel, Micron, IBM, Hitachi, Applied Materials, Dow, Merck, DuPont, BASF. It's an impressive client list for a very specialty product or series of products and software that Nova makes. This is a company behind the semiconductor equipment company makers that are behind the companies that make the semiconductor chips, right? So we're removed from the end market by a couple of degrees, but that's the way we like it. Those end chips aren't going to get made without Nova's participation along the way, and so there are not a lot of other companies that compete in this particular space, so that gives them an advantage and a significant moat, in my view. Looking for growth from Nova of 17% a year, which again, I think is very doable, and they have been able to exceed that in the last few years. As the supply chain eases, there could be some more upside for Nova, but frankly, I don't think they're really as impacted by the supply chain as companies are trying to, make as many chips as they can and expand their facilities. Nova's been part of that process, and so will only benefit further as the years continue to roll by. And then we'll wrap it up with Simpson Manufacturing. This is my one call out in the construction, building materials, home building industry. Simpson makes fastener products. They're best known for their line, the Simpson Strong Tie line. If you watch building shows on the Home and Garden Network HG or on YouTube, you will find builders using Simpson Strong Tie and referring to them by brand. Devices for joist hangers and used in wall construction, lumber construction. They also make concrete fasteners, a whole line of systems and fasteners in the concrete industry. So they have an industry leading position. You see growth has been pretty measured in the past. It's upticked a little bit as they are gaining market share by adapting to industry trends. For instance, in the construction industry, there is still a method of building high-rise and mid-rise buildings by welding with steel beams and traditional welding. Simpson has systems, materials, software that will allow those welded connections to be replaced with bolted connections or with connections that are physical, and that actually has benefits in terms of strength, stability, quality, labor, etc. So there are a lot of ways that this traditional building materials company is expanding its market offerings and expanding and growing its market share at the same time. So this is my one nod towards buying the company now and sit and wait if we have the construction industry is a little soft at this point. If home building has paused a little bit, that's going to have some impact on their business. Unlike some other businesses, we also cover Trex, which follows many of the same trends, but Trex benefits when homes aren't being built, homeowners are upgrading their current homes, and so they might be putting on a new deck. Simpson's products are really used in construction. Yes, in some remodeling instances, you might use their products, but I still think it's a high quality business with a great profit margin, great market share, growing business approach as you go forward, and globally, this could be a $5.5 billion market for Simpson's products. I will note that the company says that of the top 100 builders in the United States, all but 2 of them use Simpson products. So that has a lot to say about the company's breadth around the globe. So with that, we're going to wrap up our presentation here. I want to thank you for turning out for our subscriber webinar. As always, I'm always available by email, or you can reach me in the subscriber forum of SmallCap Informer website. In the subscriber section, you can look at the discussion forum there and post questions, and I get an instant notice when you do. And so if you'd like to have a conversation, we'd be happy to entertain you on the website as a subscriber. Thank you for being a subscriber. This is our 10th year. So we're certainly happy with our 10 years of existence. A lot of investing newsletters don't reach that 10-year point. So we're very pleased to be celebrating it and that you have been along with us for the ride. With that, thank you to Sean and Russell in the back office. Thanks to all of you for being subscribers. We'll look forward to seeing you online and seeing you at our next subscribers webinar. All the best for 2023.